Now I'm going to discuss EPF and ETF adjustment. Think EPF as well as ETF, Employee Provide Fund as well as Employee Trust Fund. EPF both employee as well as employer give their contribution. But ETF only employer give their contribution. Only employer. Employee in business and employee percentage 10%, employee 15%, but ETF employee 5%. This is the legal requirements. Right, think gross salary. If gross salary of the business, think about 600,000. EPF and ETF should be calculated based on gross salary. Therefore, 600,000 into 10%. 10% equal 60,000. As well as 600,000 into 15% should be calculated. Employer contribution 90,000. But ETF employer contribution equal 5% equal 30,000. Think value should be calculated based on gross salary. Then employee contribution should be deducted from gross salary and paid in cash balance part. Therefore, from gross salary equals 600,000. When business going to pay salary to the employee after deducting employee contribution, think 60,000 should be deducted. This is EPF employee contribution. EPF employee contribution should be deducted from gross salary, balance amount paid in cash. Therefore, this is called net salary. Net salary. When business going to pay salary to the employee, contribution of employee should be deducted from gross salary and balance part paid in cash. Right, you have to know how to record in the ledger accounts. Think EPF divided by two parts, employee and employer. But ETF only employer give their contribution. Value should be calculated based on gross salary. When business going to pay salary to the employee, from gross salary deduct EPF contribution of employee. Therefore, this is called net salary. That is the value paid in cash. Therefore, when recording in the ledger accounts, step number 1 net salary. Then second step employee contribution. And third one employer contribution for EPF. ETF also employer contribution for these steps. You have to apply 4 steps. Right. Think net salary paid in cash. Therefore, you have to prepare cash accounts as well as salary accounts. Think step number 1 salary as well as cash. Therefore, double entry paid in cash, effect for cash decrease. Cash account credit 540, values in 1000. Cash account credit as a salary. And salary account debit 540,000 as a cash. Think net salary paid in cash, effect for cash decrease. Cash account credit, salary account debit. And second step, employee contribution equal 60,000. Also part of salary. There are two separate ledger accounts. Salary accounts available, part of salary contribution of employee also, but you have to prepare EPF payable. EPF payable. Think EPF and ETF fund maintained by the central bank. Therefore, each and every month, business should be sent to the central bank. Contribution of employee as well as employer. Think employee contribution part of salary. Therefore, step number 2, 60,000. Salary account debit as an EPF payable. EPF payable. EPF payable account credit 60,000 as a salary. Think contribution of employee also part of salary. But that value should be sent to the central bank. Payable. Therefore, salary account debit, EPF payable account credit, contribution of employee. And the employer contribution. It is not part of salary. Therefore, separate expense. Contribution of employee, separate expense. you have to prepare separate ledger account as a EPF expense. EPF expense accounts cannot be deducted from salary. It is not part of salary. Therefore, employer contribution 90,000 separate expense of the business. EPF expense account debit as EPF payable and EPF payable account credit 90,000 as EPF expense. Think contribution of employer part of it is not part of salary, another expense. ETF also same way, only employer contribution. Therefore, two separate ledger accounts, ETF expense accounts as well as ETF payable. ETF expense accounts as well as ETF payable. Therefore, think employer contribution equal 30,000, double entry, ETF expense account debit as ETF payable. ETF payable account credit 30,000 as ETF expense. Right. Think there are three expenses available: salaries expense and EPF expense as well as ETF expense. Think salary account as a balance available gross salary. Therefore, gross salary should be included under administration expense. And EPF expense, ETF expense also under administration. But think EPF payable as well as ETF payable, those are should be sent to the central bank. Therefore, liability should be recorded under current liability. Think EPF payable account available both employee and employer contribution. Right. Think salary account as salary should be included under administration expense, gross salary. Therefore, salaries expense should be closed. Expense account should be closed. Debit side increase, take those value credit side, difference value as income statement. All the expense account should be closed and liability account should be carried down. ETF also expense, therefore debit side increase, take that value credit side, difference value as income statement, it is called closing entry. As well as ETF expense, think there are three expenses should be recorded administration expense any organization. Therefore, difference value should be considered as expense. But think payable is a liability. Therefore, liability should be balance carried down. ETF payable also same way. Think payable credit side total money equal 150. Now cannot be considered as income statement. As BCD balance carried down 150, it should be recorded credit side as a BPF. This is value should be recorded under current liability. ETF payable also same way. Think credit side increase, difference value as balance carried down, and it should be recorded credit side as BPF.
Biscuit ginala biscuit.
Oh no.